Deceased founder of Vanguard, Jack Bogle, if he was alive today, he'd have a warning about the stock market. I'll share that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So legendary investor, founder of Vanguard, Jack Bogle. I mean, in many ways, his legacy is built on passive investing, meaning, listen, don't be a stock trader yourself. Just invest in some high quality, low cost funds, AKA be a passive investor, and just hold those forever. And so many people could extrapolate that and say, well, you know, it really doesn't matter whether the market's high, low, whatever. I'm just supposed to buy the index and I'll just ride through it. And, you know, for us, depending on your financial plan, that's maybe part of your overall investment philosophy, probably not your entire investment philosophy. I would argue the late legendary investor Jack Bogle would say the same thing. In fact, this author here of this article would say the same thing as well. Jack Bogle also looked at the market and would have said, hey, things are high, things are low. And not that he would have abandoned his passive investment philosophy, but he certainly, if you were alive today, would be sounding the alarms about the market today. So Jack Bogle says that said that there were basically stock market returns come from three different sources. And logically, I mean, this is right. And lots of inputs and factors kind of go into these three sources, but this is it. Number one, if a stock pays a dividend, that's a return. That's a return to its investors. So part of your return, if you hold a stock or a mutual fund of stocks that pays a dividend, that's part of your return. That's obvious. Okay, so that's one. The second source of returns that stock investors receive is earnings growth or earnings per share. Obviously, if a company has earnings of $100 per share, the company's worth X, right? But if they grow those earnings to $1,000 per share, okay, then that company should be worth more. The company's stock will likely go up in value because they've had earnings growth, right? So that makes sense. If a company grows when Microsoft was in Bill Gates's garage, or I don't know, when Apple was just in a garage, had very little earnings per share, right? And now that it's enormous, those earnings per share are significantly higher, and of course the stock is significantly higher as well. That's a terrible example, but you get the drift, okay? So stock returns come from dividends, of course, comes from earnings per share and earnings per share growth, yep, of course. But then Jack Bogle said the third source of investment returns, stock returns, come from speculative returns. Speculative returns. And how he defines this is just the ebb and flow of the PE ratio, what investors are willing to pay, price, for a dollar's worth of earnings for that company or for the overall stock market. And Bogle actually says, you look back over 100 years of history of the stock market, the PE ratio has zero effect on the stock. Zero effect. And it's important that he says looking back over 100 years, because obviously in any moment in time, the PE ratio is wildly different. But he argues, and I haven't looked at all 100 years worth of data. I'll show you some of the data here in just a moment, but that, listen, there are times when the market pays a lot for a dollar's worth of earnings, so the PE ratio is high. And there are times when the market pays very little for a dollar's worth of earnings, where the PE ratio is low. And if you balance all of that out over the long term, averages kind of fall back to averages. So if your PE ratio is above the long-term average, that means you've had more return than maybe you should have over that same time period, and eventually those returns will come back down. If your PE ratio is lower than the average, then you've gone through a season where your returns have been lower than they otherwise would, and you should be watchful that those returns should elevate over time. So he would argue those are the three places that returns come from for a stock investor. Your dividends, of course, yep, earnings per share growth, absolutely. And then short-term PE fluctuation, but long-term, the PE has a zero effect on the stock market. So what's it say about today? Take a look at this chart directly from the author warning about, Jack Bogle's philosophy and where he says returns come from. I mean, take a look at the excess return of the stock market over the past 10 years compared to the actual earnings per share or earnings growth we've seen over the past 10 years. Let me say it differently, but a picture's worth 1,000 words. The earnings per share or the earnings have seen a 50% growth over the past 10 years. But the stock market has seen a 200% growth over the past 10 years. This would argue, or Jack Bogle's philosophy applied to what this chart is saying about today, says we have actually seen significant outperformance in the short term that will likely need to give back over the long term because we're in a season where people are paying more price for a dollar's worth of earnings than the long-term average. Take a look at this chart as well. This goes back 25 years and it looks at, this is forward PE ratios, and obviously right there in the middle, that band that sort of looks like a street in the middle there where dotted lines and then a solid line above and below. That's average. That's the 25-year average of the PE ratio, the forward PE ratio, and you can see I've shown this chart in previous videos as well. Back in the tech bubble, late 90s, early 2000s, you see that PE ratio was well above those averages. You would say the market was high at that point. Investors were paying a high price for those earnings at that time, okay? And then you can see during 2008, we were below, that PE ratio at that time was well below the long-term average. So you would say the investors were paying very little, so low price for a dollar's worth of earnings. And then look at where we are today. And so this essentially makes, and now this is only 25 years, not 100 years, but it essentially makes Jack Bogle's point that when you look at the average, okay, that's where long-term the stock market should be. It really should be, you should be pricing the market based on dividends and earnings per share growth, and that the PE ratio just kind of ebbs and flows, okay? Sometimes it's high, sometimes it's low, but you should be comparing it to the long-term average. So right now, because we're seeing the PE ratio significantly higher than that long-term average, you would argue that the returns that we've seen recently over the past 5-10 years it's very possible we could be giving some of those returns back when we look out into the future. When? I don't know, and no one knows, but we've likely seen more returns over the past 5 to 10 years than we otherwise should have or would have, and we might be giving some of those back in the near future. And the final point that I'd make here is these authors here in this article, sort of extrapolating some of Jack Bogle's philosophy. I think that's coming out in a book by some MIT folks. But anyways, I mean, if you take his inputs, he says dividends plus earnings per share, and then there's speculative growth, but that's all short term. There's speculative returns. That's all short term. That ebbs and flows. That's that PE, whether investors are going to pay too much or too little, but long term, the average will have zero impact on the stock return. So basically, he's saying if you cut through the noise of how the PE is moving, you could create expected returns. You could calculate expected returns by looking at earnings per share plus dividends. Okay, earnings per share plus dividends. And right now, dividend yield in the S&P 500 is, call it 1.5%, 1.5 to 2%. Okay, that's fairly low. And earnings per share about 3.5%. So the future, the kind of expected return right now for the future of the stock market is 5%. That's significantly lower than the 10 to 12% actual returns that we've seen over the past decade or so. That's a stark difference. And therefore, once again, this could mean we could be giving back some of these over returns or abundant returns that we've seen above and beyond Jack's actual calculation that we've seen over the past decade. So what do you do about this? Should you run and hide? I mean, is the whole purpose of this video to scare you out of investing? Absolutely not. Absolutely not. It's just a reminder, a different perspective. Almost any way you slice it today, there's lots of noise, there's lots of justification about these high PE ratios, and I would make some of that justification as well. But no matter how you slice it, the market is high. The valuation is high. And could it stay high for a long period of time? Absolutely. Absolutely. The Fed is now in charge. There's all sorts of different dynamics happening in the market. Could stay this way for a long time. So don't expect that the market's going to crash tomorrow because some wise money guys showed some charts that, hey, things are high right now. No, it could stay this way for a while. The point is, make sure you're not taking too much risk than you otherwise should for your overall financial plan, okay? If you're risking it all on the hope that the market continues this 12% tear, I would tell you odds are, I mean, it certainly could in the short term. Anyone, no one knows the future, but odds are it probably won't be able to continue that tear for the next 10, 15, 20 years, okay? And some sort of reverting back to average or normal returns is more likely, okay? So make sure you're taking the right level of risk for your overall financial plan. And then second, as I've said several times, I would make sure that you've got a sound investment philosophy that works during these 12% a year type of returns that we've seen over the past decade, but also can work if we see those returns snap back to reality, okay? Don't get used to those 12% average annual rates of return. To us, that is having an index or diversified approach that's consistent with your long-term financial goals, coupled with a dynamic or an adaptive or a momentum strategy that can adapt to changing market environments. Those two philosophies together, they're great complements, can help you ride out, basically participate when the market's feeding you elevated returns, but also help protect and adapt when the market's feeding you below average returns. Work with your certified financial planner on that. Make sure you've got the right risk for your financial plan and that you've got the right investment philosophy regardless of the environment. If your CFP is not helping you with that, you can always contact one of the CFPs on my team. Find us online, corehorn.com. That's Corehorn with a K. wisemoneyshow.com. You can find us there as well, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.